Okay, looks like we're live.
Okay, well, I think we're live. So welcome to today's webinar. Does your retirement plan design still make sense in a COVID-19 economy? Hosted by Sobel & Company. I'm Chris Schiffer, Vice President with Wealth Enhancement Group and moderator for today's webinar. Before we start, just a few housekeeping items. Today's session is eligible for 1.5 CPEs, and we'll be polling questions throughout the webinar in order to be eligible for the credit. And then upon completion of the polling questions and the survey at the end, you'll receive a CPE certificate in a few days. We have 1.5 hours for today's presentation. The panelists will cover FAQs on retirement plan design and in COVID, and we've left plenty of time for questions. If you have any questions, please enter them in the Q&A box, which you'll find on the control panel, or you can send me a private chat if you don't want the question to be public. And we might answer some questions. Some of the panelists might answer the questions during the course of the presentation. So keep an eye on the Q&A. And also, you can get a copy of the presentation under the Handouts tab. With that, our presenters for today. We have Brian Bregoff. He's Vice President with Retirement Plan Solutions at Wealth Enhancement Group. Brian leads a highly qualified team and oversees retirement plan governance and fiduciary responsibilities for his clients. And he has over 20 years of broad experience working with retirement plans for large million-dollar corporations, multi-million-dollar corporations, as well as small businesses. And Brian supports his clients by designing custom retirement plans that are focused on specific goals and needs. And he shares his knowledge through employee education programs and that help participants navigate savings for retirement. Also with us today is Brian Bellowin. He's a Senior Sales Director at Mann Marblestone Group. Brian has extensive experience in all aspects of retirement planning, from advisory services to record keeping, and worked with 401ks from just about every angle. Brian has a team at Mann Marblestone that includes both a group of actuaries and ERISA attorneys, which allows Mann Marblestone to prepare and tackle administrative or plan design complexity that comes their way. Also with us is Tom Howens, also from Mann Marblestone. He has served as Chief Operating Officer of Mann Marblestone Group and is a leading provider of legal, actuarial, and third-party administrative services for qualified plans. And finally, of course, we have Liz Harper from Sobel & Company. She's a member of the firm and Director of the Quality Control and Employee Benefit Plan Audit and Consulting Group. Liz is responsible for reviewing all the financial statements and service organization control, SOC reports issued for the firm, along with client correspondences, including ensuring the highest quality standards are met and the reports are in accordance with established authoritative standards. Liz is dedicated to ensuring the firm complies with internal quality standards. This includes involvement with the engagement teams during all phases of work. Liz is also responsible for client service, SOC, employee benefit plan engagements, and other audits. And without further ado, I'll hand off to Brian Bregoff to start. So next slide, and Brian, whenever you're ready.
Great. Thanks, Chris. Thanks, everybody, for joining this morning. Hope you all coming off a great Thanksgiving day and weekend. As Chris said, I've been working with retirement plans for over about 23 years now. I'd have to say the last 5 to 6 years have been by far the most interesting of all times. And not because anything has really changed drastically, I think, across retirement plans. It's more about, the fact that I think there's more attention being put towards them. There's been such a set it and forget it mentality around retirement plans for so long that I think, the industry and Department of Labor have really kind of taken the steps over the last couple of years to say, now it's time that we really got to make sure, clients and plan sponsors are really doing what they need to do to look at a plan. And, with that said, I think I'll jump to our first polling question. If we want to pull that up. Do, Actually, that wasn't my question, but I'll ask it anyway. Does your company sponsor an existing plan? Yes, only a 401k plan. Yes, combination 401k and profit sharing, or yes, combination 401k and profit sharing and defined benefit cash balance plan, or no. We'll give you a couple, about 30 seconds to answer that question. And do we have some results from that? Colleen, are there results from that question, Colleen, or do we see those results? I'm sorry, I'm not seeing them.
Polling tab, the results are there.
All right, I guess we'll get to those results in a little bit, as I didn't see the results come through yet. So,
Brian, can you hear me, Brian? I have the results.
Okay.
Excellent. So we have 80% of the audience, their company sponsors a 401k plan.
Okay.
And the next we're tied with a 401k and profit sharing combination. And a few other people don't have a plan. So I would say the majority of those on the call are 401k plans.
Great. Well, and that's important because, as I said, with the tension being put towards retirement plans these days, and especially 401k plans, I think one of the most important things the Department of Labor has looked at, or we see, is having committee meetings for your retirement plan. As advisors, we meet with our clients regularly. And regularly means, could be once a year for, depending on the size of the plan, could be twice a year, 3 times a year, 4 times a year. We even have some plans we meet with more, to have our committee meetings. And the committee meetings are there to do one important thing, and that is to make sure you as a plan sponsor, you as an investment committee, you as a fiduciary are doing what's in the best interest of the participants and of the participants of that plan. That's, ultimately a definition of a fiduciary. So by having those committee meetings, it shows that you're putting some attention to these plans on a periodic basis to make sure that there isn't that set it and forget it mentality. So I could even argue that, through these COVID-19 times, which have obviously been, very interesting times, would it be more important to have committee meetings during a time of stress or a time of uncertainty? And I would argue, yes, that is an important thing to do. Should we be looking at the plans and saying, well, what is the plan design, doing for us and for our participants? How are the investments doing? Are there participants? Should we look at the plan demographics? How are the participants doing anything unique that we should address from an education perspective? And this is all part of what those committee meetings should be handling. So yes, over the last couple of 7 months or so, we've had committee meetings virtually with all of our clients, some multiple times, just to make sure that we're covering ourselves from that fiduciary perspective and documenting everything. So we're holding our regular committee meetings. We're doing, if we could do face-to-face, we would. If matter of fact, we had our first face-to-face about a month ago. We're all 6 feet apart, socially distanced, wearing masks, but we had our first, one of my first face-to-face meetings. But otherwise, virtual meetings were just as good. You could take attendance. We're drafting minutes. All that extremely important. Of course, during those committee meetings, you should be leveraging vendor reports, whether it's investment reports, plan demographic reports, pulling out your IPS, and I'll talk a lot about the investments in a minute. But investments have been very interesting, over the last 7 months. How have your investments done through this whole volatility of the market? And then, most importantly is what's down at the bottom there, keeping the written minutes of the committee meeting. I've sat in on a couple DOL sessions where I've heard, we've had the, speakers from the DOL talk. and ask them, what are the most important things you're looking for from an audit? And every single one of them says, oh, minutes from your committee meeting. And minutes, just because, as I said, what's most important is to show that there's some attention to it. So, despite all the plan documents that are needed and document and disclosures that should be going out and agreements, they really want to see that minutes are there, because the minutes encompass everything that you're doing, or all those should encompass everything that, a plan sponsor or those fiduciaries should be doing as they review their plans. So, one thing we think throughout the COVID-19 is we've seen a lot of plans. Oh, hey, your company's having troubles with dealing with the uniqueness of the environment, maybe struggling from a business perspective, and a lot of times the 401k plan gets put aside. But it's really important that if you haven't had that committee meeting yet, that you really get one in place before the end of the year, because obviously we're not out of this COVID-19 situation yet. And it'd be great as you're approaching year end to review your plan and its information. As part of that committee meeting, yes, one of the most important things to do is that investment review. I mean, let's talk about investments, right? So we're here in the middle of a pandemic. We saw, March come, we saw the market drop pretty drastically. And then we've seen it come back, and I think it's almost at an all-time high. Matter of fact, the Dow hit over 30,000 right this past week, or the last week, which I think was an all-time high. So we've seen such volatility. So how have your investments done throughout that? Oh, and by the way, we're on an all-time high, and yet we're still in the middle of a pandemic. We've still got some civil unrest out there with some of the protests that had happened throughout the year. We just went through an election, and we're at an all-time high. So how are your investments doing in relation to that? We saw a lot of plans and plan sponsors look at their investments, and we saw the volatility, we saw the market go down, we saw their assets go down, and they panic, and they're like, well, we got to make some changes or whatnot. But it's really about looking at the long-term strategies of each of your investments. Using somebody to really dive into the investment, look under the hood, whether it's a CFA or some kind of investment professional, to really look under the hood and say what's going on under there. Having calls, simple calls with some of the investment fund managers becomes very important to understand what their strategies are throughout this, because strategies do change. And if they change, should you be reviewing that strategy to say, is that still the right investment for our participants in our plan? And then, of course, document any comprehensive qualitative due diligence data for every fund manager. So everything should be documented in there. But more importantly, participants are different. There's really no two participants that are the same. Some are more savvy. Some want the autopilot funds, the target date funds, those QDIA funds that you have. So those target date funds have become extremely important. If you probably talked about them 10, 12 years ago, maybe 30, 40% of the plans had target date funds. Today, if you look at the statistics, it's like 90%. Almost all plans have some type of target date fund in there, because it's really a great set it and forget it fund for a lot of the participants. Many participants who are not really, investment savvy want to know that, hey, I've got diversification. It's being managed to my retirement year. It's all being done for me. So those target date funds are extremely important. But with that comes a lot of responsibility. Department of Labor many years ago came out with their recommended tips on how to analyze target date funds, and suggest that should be reviewed annually as part of your committee meeting. So extremely important process to look at. And then, of course, there's a lot of different ways to look at lineups. Again, looking back many years, many lineups were very diversified. You pulled up I can invest in my 401k plan. I pull up, I go and enroll, I select my percentage that I want to contribute. I go, hey, now pick your funds, and you look at it, and there's 75, 80 funds there. And you say to yourself, whoa, I have no idea what to do here. And you get scared, and people back out, and they don't finish their enrollment. They never enroll in the plan. So that was years ago. Today, we've seen more of a consolidation. Again, this is long-term savings. Maybe it makes sense to have more of a less broad investment lineup for your participants, keeping those target date funds in there, which is your alt and your QDIA. But does it make sense to have a large cap blend fund, and a large cap growth fund, and a large cap value fund and a mid cap blend and a mid cap growth and a mid cap value and a small cap, and I can go on and on and on. Does it make sense to have all different sleeves? Maybe. It depends on your employee population, and depends on your demographics. It depends on the knowledge of those participants, whether it could make sense to have those. But again, all important aspects to look at as you're looking at the selection process. And then lastly, with the monitoring process, and again, part of your committee meeting, to pull your investment reports. Almost all vendors today have some type of investment report out there that's available. If you're working with an advisor, they should have a good investment report available. You should be looking at it at least at every committee meeting. I know with our plans, we run our investment reports every month for all of our plans, just to make sure from a scoring perspective, they're all doing well. And if we don't have to put something on a watch list, or we don't want to need to address something specifically. You should, again, speaking with those fund managers as needed, provide performance comparison reports. How do they compare versus other funds within your category? If you have a fund and it's at the 98th percentile, not doing well, almost not scoring very well, well, hey, does it make sense to continue to keep that fund in the plan? And it may. We have plans that don't score so well, but we know it takes less of a risk. It's not as aggressive as some of the other small cap funds say. So we're okay with it because we want to take less of a risk in that fund. But as long as the documentation around that is there, it helps protect you. It's not always about the answer that you make. It's about the process to get to that answer, what's most important across all aspects. Some key components of a 401k investment lineup design: provide participants with multiple investment portfolio management platforms. Again, we talked about this really under as a lineup. From a lineup perspective, again, you have different maybe classifications of participants that are out there. What makes the most sense? Some, want those target date funds. Some want those single asset class funds where they will create their own allocation. Others may want fund advice. And a lot of the platforms out there use these managed account services where it goes in and it has all your data because it's in the record keeping system. And it says, oh yeah, I'm, whatever, 40 years old. I have $300,000 saved in my account already. This is how I've invested. This is how much I'm saving. What makes the most sense for me to kind of invest going forward? And they'll use, certain criteria to come up with a recommended allocation. Those are great solutions for many participants. Some of them come with fees though. And do those fees make sense for your participants? Some platforms will do a opt-in option, which means that if a participant opts in, they charge a certain percentage to that participant. Others will allow you to say, hey, roll it out to the whole plan and we'll just charge you a smaller fee, and then it's available to every participant. So there's a couple different ways to look at how you want to include those types of solutions. Enable participants to diversify their retirement savings, minimize risk of large losses and active conviction, especially with in this market. Obviously, we saw a lot of volatility from at the end of March heading into April. And now obviously we've seen the market come back. But there's been a lot of volatility, and, whatever decisions you make, need to, stick to those decisions, have confidence in those decisions. And don't be afraid to make those changes as needed. We've had a number of fund changes that we've made through this because we didn't like the way the fund manager was handling, some of the volatility out there. So we made decisions to change some of the funds. Keep investment costs as low as possible. Of course, that's been a big factor over the last couple of years. How do we, obviously index funds is one way to keep costs low. Almost all funds out there come in different share classes. And if you all know the difference between any share class, the only difference between any share class is just the fund expense ratio. So if you can go get a fund for 100 basis points or the same investment fund for 40 basis points, which one would you want? I would assume it's the 40, right? You go with the lower cost. So, keeping in mind that's an option. We're also continuing to see a trend towards common collected trust funds now. These are investment options that were really only available to very, very large plans. You needed to have a certain minimum assets in there, typically 100,000. They're even up to as high as 250,000. They've come down now since. And they are now available to a lot of plans, even smaller plans out there. They bring even lower costs, but with those lower costs, there are some other factors that you've got to consider. They're less transparent in how to report on them sometimes. So you need to make sure whatever you're working with, whatever vendor, whatever advisor, they have the ability to review those investments. And then of course the emphasis on the QDIA options should always be there. In our opinion, most participants, probably 85% of them, belong in QDIA target date type funds, because most aren't going in and managing their investments on an annual basis or even semi-annual basis. Most aren't savvy enough to understand how to review or create an allocation or go rebalance at a time. So those targeted funds, are a great solution. And as a plan sponsor, they bring you that QDIA protection. Once you get that lineup created, and you decide which is the right solution for you, even if you continue to make changes as part of your committee meetings, education becomes extremely important. The days, in our opinion, of getting into a big room and doing education, those are gone. Really, education is taking a much more personalized approach nowadays. So we're seeing a lot more education from a targeted group perspective. Maybe targeting the younger population, getting in there and talking about diversification and savings. Most younger people coming out of whatever college still have student loans, not looking to save, but do they really understand the importance of what possibly saving $100 a month could do for them at a very early age? Those types of education become extremely important. Maybe targeting an older group population who are getting closer to retirement. You could talk about Social Security, Medicare, those types of situations and how that'll affect them. In addition, provide investment education materials. Don't be afraid to provide them out, and have your participants review these materials, but simplify them. Don't make them very complicated. I mean, you can go send them a prospectus, and for any of you who's pulled up a prospectus knows it's 85 pages of, I'm not sure, very difficult read. So send them information that's, that they would understand. And then advisor on demand, new thing, which is really more personalized education, one-on-one education. Allow participants at the time when they need their support to be able to call somebody and speak to somebody. A lot of advisors do that today. We do that for all of our plans. They got a question, and they want to ask it. They can email us, call us. And basically, we'll get back to them, right away to kind of with an answer to that information. And then targeted communication, as far as just continuing to send out, we've seen a slowdown in the type of communication that's been going out lately, and we believe that education should be ramped up a lot, especially due to a COVID-19 situation when there was a lot of concern. That brings us to the financial wellness piece. Financial wellness basically says, let's take education to a little step further. How can you help participants with more of an overall financial analysis for themselves? Maybe they got situations with they're just getting, they just had a baby. They want to start a 529 college savings plan. Maybe they need some insurance or whatever it may be, but how do you help them from a larger financial wellness, perspective? This is in 2019, the two most widely Googled retirement terms for retirement plans was financial wellness and auto enrollment. So financial wellness is becoming extremely important. Most plans are starting to look to add this. We've got about a 50% rate today that have some type of financial wellness program in their plan, and we're continuing to see a major ramp up in this. So, and especially throughout a COVID-19 situation like we had, to have the ability for those employees to reach out and speak to an advisor to get some advice or help them with some of their concerns, extremely important. Brian and Tom will talk a little bit about the CARES Act that came out. There was, how can they address those questions? And using, having a financial wellness program may help get those solutions answered. Lastly, I'll talk about the one big thing that we saw throughout COVID-19 situation, and actually it's been growing, is just, to review your plan security protocols. There's been a huge insurgence of security issues, cybersecurity issues in general. We're starting to see some activity with this around retirement plans. It was actually quite interesting. I had a guy from representative I know from Fidelity tells me that at their facility, they've got a big sign up, and it's just a number and it keeps rolling up, and basically what that is how many times somebody's trying to hack through their firewall, and it's the numbers in the tens of thousands, and because it's become a big issue, and what's so even from a plan sponsor perspective, there are really certain security measures that should be taking. They cause large headaches. You don't really want to have to go through them. And we're starting to see, like I said, more of a certain. So how can plan sponsors minimize this risk? They should conduct their due diligence by completing a risk analysis for the plan. They should put up a cybersecurity policy and procedures in place, just like you have an IPS, and there should be maybe an FPS or fee policy statement, or you should have some kind of cybersecurity policy in place and how you would handle it, how you're training employees. Conduct a thorough usage analysis to identify every party with access to the retirement plan. We had one situation. Plan sponsor for a client was that the office manager was let go, and she was disgruntled, and she still had access to the plan. They never took it away quick enough, and she was able to get into the plan. And so you never know which vendors need which data. Be careful how you send data nowadays. Of course, everybody's got sends stuff through emails. Do you have some secure way to send the emails? And how do you transfer files back and forth to the vendor? And of course, verify the vendor security. Like I said, Fidelity, I mentioned how they have all those, that number with all the people trying to get in their firewall, but Fidelity's got a great security protocols. And, the fact that they're able to identify and stop that and maintain that, goes a long way. So depending on whatever provider you have, don't be afraid to ask them, what security protocols they have in place. So in general, in summary, very interesting times, but I think the way to handle this situation is really just to not forget about your plan, to put those measures in place, to go out there, review your plan, review all the specifics that you need to, whether it's investments, plan design, education, disclosures, and make sure that the security, social, your cybersecurity measures, make sure that there's some policies, some procedure in place to take a look at it and document what's being done around that. So with that, I thank you. I will turn it over to Tom, who will talk a little further about the CARES Act and other situations. Tom.
Hey, thank you, Brian. Appreciate it. As Chris had mentioned, my name is Tom Hones. I'm the Chief Operating Officer of the Man Marblestone Group, and I'm joined with Brian Boulogne, who will pick up a couple of slides in on this presentation. For those of you who don't know, Man Marblestone was founded in 1975, shortly after the ERISA law was enacted. And our focus is really on the plan sponsors and setting up and maintaining appropriate retirement plans that work for their business needs. We handle all the legal, all the actuarial, all the administrative and consulting work for over 1,100 qualified plans, and are regularly working with people like Chris and Brian at Wealth Advisors on those plans, as well as people like Liz on the accounting and auditing side, because we do not get involved in investing our clients' money. We're strictly focused on the plan sponsors. And why is that important to this group? 88% of the people in this audience already have a plan. And now is the time for each and every one of you to open that plan up and read it. We are heading into what's called a restatement period with the Internal Revenue Service. And like a lot of things the IRS does, this is not optional. Every plan must be restated. So now is the time to look at these provisions that Brian was talking about earlier, and that we're going to continue talking about throughout this whole presentation. So, keep that in mind.
Okay, before you go any further, why don't we do the polling question that we should have done earlier?
Sure thing.
Okay, can you see it? No, I don't see it. You're back. Never mind. Wait, you did see it? Andrew, you see it?
I saw it.
Okay, there it is. Sorry.
That's fine as we're running up. If we can shift to that next slide. A lot has happened in the world of retirement plans with the Secures Act that came out, it seems like decades ago, but it was just before COVID, and the CARES Act on March 27th. But our number one kind of question that ruminates in people's minds is a little less of if Biden wins, because that's a foregone conclusion, but rather, given the lesser number of people he has in the House and the tightness in the Senate, can he get his will through Congress? And what he has said, and I take him at his word, is eliminating the new plan startup credit. We always had one. It was in the act, but the Secures Act really increased the new plan startup credit. And this is important for everyone, because a new plan is not just a 401k. The new plan could be an add-on profit sharing plan for those people who have a 401k, or the add-on cash balance plan for those people who have a 401k and a profit sharing. So the way the Secures Act is written, the credit is 50% of the startup costs of a plan. And that's calculated as $250 times the number of non-highly compensated employees eligible to participate in the plan. The maximum credit is $5,000 per year. So that hits around 20 non-highly compensated people, which is kind of the average plan in the United States. And you get that for each of 3 years. It's a huge number. And, among other things, Joe Biden is looking at cutting that back. The second one is probably the one he's most likely to give up. And that is to change the taxation of participant contributions into the plan. The $19,500 that participants can put into the plan, he wants to put that back into your gross income and give you a tax credit for your contributions. That has the impact of raising your taxes, and it's somewhere, there are a couple of models on this, but it's somewhere around $80,000 of income, where $80,000 and above, you're going to be paying a lot more in taxes than under the current system. The last piece, which affects a lot of folks, because $400,000 is the limit at which he intends to substantially raise your taxes. And the question is, how is the $400,000 calculated? Many plans are out there that are housed in entities that are passed through, whether it's a subchapter S, an LLC taxed as a partnership, etc. Once you hit that 400,000 of, what is it, gross income, taxable income, we're not really sure where he's striking that line. The question's going to be on those sponsors. How can I design a plan so as to reduce that number and help shelter some of the taxes? And if we could go on to the next slide. I don't want to talk about everything on this slide, but we touched on the increased tax credits for the plan sponsors, but the next two are going to be extremely important. The retroactive adoption is extremely important right now. Up until now, with a qualified plan, you had to have a plan in place by December 31st in order to take a tax deduction for that year. Many folks have come into their accountant's offices in April and saying, what can I do? And the only answer after January 1st is set up a SEP. A SEP is the only answer, or was the only answer. But unfortunately, it's a very inefficient method of saving for saving for retirement, and the cost that it has on a plan sponsor. SEPs sound simple. Simple's even part of their name, but there is an administration component, and I've seen issues where misadministration of a SEP has led to reallocation of money inside the plan such that 80% of the money has flowed away from the owner who thought they had saved and ended up in the hands of employees or contractors who never once thought they were part of a plan. So retroactive adoption is big. It means that even after January, you can set up a 401k, you can set up a profit sharing, you can set up a cash balance for the prior year and take that full deduction against your taxes. That I think is going to be huge. I also think it's going to add some difficulty into what Liz is doing in her world of auditing these plans, because now you don't have to have them in January. You can have them in April. You can have them in May, depending on how you've set up your taxes and gone on extension. Part-time eligibility, we're at the leading edge of this. Up until now, you could exclude people from your 401k plan who had less than 1,000 hours worked per year. That's now changed, and people are now being encouraged to accept into the 401k those long-term part-time employees who never quite got to the 1,000 hours. So 500 hours is now the rule. And right now it's a tracking thing. You've got to keep track of those people, because once they're in for 3 years at 500 hours, they are now in your plan and can defer. But you don't have to give them a profit sharing contribution. You don't have to bring them into the cash balance plan, but they are eligible to be in your plan and start deferring into it. The Secure Act opened that participation. So we'll see what happens with the Secure Act in a Biden administration, because this is actually a nice benefit for those folks. It will, however, make the administration of plans more complicated. And as the Department of Labor has looked at these plans over time, they are sticklers. They have absolutely no sense of materiality, and they have no sense of humor. So being able to document that you've got your people, and hit that 500-hour limit is going to be very, very important in the compliance aspect of your plan. And starting in 2024, it's going to be important when Liz comes in and does her audit. With that, I'd like to hand this over to Brian.
Thank you, Tom. And I'm going to pick things up right in the middle of the slide with the fourth touch point on auto enrollment and the cap on that going up to 15%. The cap prior to 2020 had been 10%. So this isn't going to make waves, as most folks aren't using that 10% cap as it is, unless you're looking at some professional service firms out there. But I think this gives us an opportunity as a country and as individual businesses to kind of level set and take a look at what you're doing currently and see if that's truly driving positive saving habits. And I think that kind of touches back on what the other Brian Gregoff touched on earlier with financial wellness. And one statistic we're hearing all the time is the fact that 1 in 3 employees actually spends an hour each month at work looking at their personal finances. So that's the kind of thing that we're trying to defray. Are you doing enough as a business to get out in front of that and make sure that your employees feel comfortable being where their feet are and in the business at work, rather than looking at personal finances? Or is there something we could do with that auto enrollment feature to maybe change that dialogue a little bit? Moving down the next touch point, the 3% non-elective safe harbor notice requirement has been eliminated mostly. And the reason we're saying mostly there is there's a lot more flexibility with the non-elective format now, as you can actually elect that up until 30 days prior to the end of the plan year. So actually December 1st or today would be the last day you have the opportunity of doing that 3% non-elective safe harbor contribution, which would go to any eligible employees. And there's actually flexibility if you do get past that last 30 days to still implement a non-elective safe harbor. Only you would need to contribute 4% at that point if you are in that last window. So the big thing here to keep in mind is just flexibility, especially in a year like 2020, being able to kind of level set at year's end, take a look at what's happened, who's putting money into the plan, and look at options at that point is going to be night and day compared to the what you would have seen in past years when you didn't have quite as much flexibility with the safe harbor. And then the next touch point, PEPs and MEPs, may be good, may be bad. So right off the bat, PEP is essentially the newest spin on an open MEP. The big changes that you're seeing with the PEP is, or a pooled employer plan, is that you're looking at one single 5500 filing. There's no audit required if the entity or the whole plan is under 1,000 lives and each sponsoring entity is under 100 lives. And another big change from what we've seen in the past is the removal of the one bad apple rule. So in the past with the MEP, if you had a tainted plan underneath the MEP, the entire MEP had an issue they had to deal with. Going forward, what they've done is eliminate that rule so you can spin off that tainted asset and deal with that individually rather than having to address that as a pooled employer plan as a whole. So the big thing as far as Man Marblestone's role in the PEP is that it does require a 316 administrator. So this is something that we are prepared to step in and assist with if need be down the line. Having said that, I think there's going to be a little bit of a delay in the uptake on PEPs as a whole, as there's a lot that needs to be determined in how these are going to be structured going forward. What we've seen in the past with open MEPs is you get one or two big plans and a bunch of little plans kind of latching onto them just to kind of create economies of scale for those little plans. But in that situation, you've got the big plans subsidizing the small plans, and is that really good for anyone in the long haul, and kind of begs that question. So I think there's a lot to be determined on this front, but this is going into effect as of December 31st this year, so we should see a lot more on that in the months to come. And the last touch point on this page, stretch provisions eliminated from defined contributions in IRAs. This is basically the closing of a loophole. Stretch IRAs were never meant to be a wealth transfer tool. So they've essentially cut that lifetime stretch provision down to a 10-year period. So just another reason you need to work with your advisors, work with your TPAs, and try to come up with more more creative solutions on the tax front. And continuing along with the Secure Act, I'm going to touch on a couple participant-centered ideas with the Secure Act. So right off the bat up top, the IRA contribution age cap has been removed. And I think this is just a sign of the times with what we're seeing in the country is we're seeing a lot of folks working into their later years and trying to build that nest egg for their heirs or for retirement. And this is just paving the way to do that a little bit further. Lifetime income, the next touch point down, this is twofold. One requirement under the lifetime income portion of things is that participant statements for 401k plans are going to require an illustrative feature actually showing what the income will look like in retirement. The second aspect to it is that it also requires portability of lifetime income features. So if you've seen any of the record keeping platforms that do have this income benefit or income rider available under the program, what the lifetime income provision is saying is that if your plan is to move as a company, you need to be able to maintain that benefit base you've accrued as an individual. So what we're seeing these firms do as record keepers is basically offer an IRA option where you can maintain that benefit base and allow that individual to roll assets into that IRA to maintain that accrued feature. The last touch point under the Secure Act I'm going to go over today is the birth and adoption withdrawal provision. This did go into effect as of the 1st of this year, and it basically allows for a $5,000 withdrawal per child from plan per parent. It is completely optional, but it's a protected provision. So once it's rolled out, it needs to be maintained for those folks it's been offered to. And it does apply to adoption, but would be restricted from including the adoption of a spouse's child. And one of the nice things about this from a HR or business owner perspective is the fact that if you don't have an in-service withdrawal provision in your plan currently, this is actually something that functions separately from that. So you don't necessarily have to roll out an in-service withdrawal provision just to make the birth or adoption withdrawal available. And the last piece on this note, it is available to be repaid and would be treated as a rollover at repayment. The terms of how that would be structured and how that repayment actually would be acknowledged by the participant is still TBD, and we're looking for a little bit more clarification on that in the months to come. But the idea is that the participant does need to be able to repay it to the plan. So the key here is just flexibility. Again, the Secure Act and CARES Act are both trying to create flexibility for participants, and this is just another way of doing so at a major life event. And I'm going to flip over the CARES Act now.
Brian, do you want to
Yes.
go through? It's time for another polling question.
Gotcha. Okay.
Okay, so
All right.
there we
Are
go.
you considering waiting until 2021 to decide either to start or enhance your plan? Options here are already have an existing plan in place, no change expected. Already have an existing plan in place, considering adding on to it. No plan in place, no change expected, and no plan in place. We'll wait until 2021 to determine if changes make sense. So we'll give you a moment to answer that. All right. And just for the sake of time, I'm going to continue along while folks are going through that. And so diving right into the CARES Act. Up top, the first touch point goes into defined benefit and cash balance plans and how the minimum funding for 2020 has been postponed. So the one thing to keep in mind if you are a business owner thinking about pushing off a contribution is that you are still going to be on the hook for that 2020 contribution. If you don't make it today, you will still need to make that in 2021 in addition to the typical 2021 contribution. So the thought being, if you have the ability to make it today, although there is flexibility, it might behoove you to actually go ahead and make that contribution now rather than kind of passing the buck down the road. The second touch point on this page, qualified individuals. And this is a bit of a broad term, but basically refers to anybody who's experienced financial difficulty due to COVID-19. So this could be loss of employment, furlough, reduction in hours, loss of child care due to quarantine, basically anything under the sun relating to COVID-19. And all you need to do essentially is self-certify that you've been impacted in one of those ways to become a qualified individual. So keep that in mind as we're looking at the next couple of touch points here. So moving on down, the loan repayments. Loan repayments have been paused through year's end for those qualified individuals that have been impacted by COVID. And again, this is just the CARES Act trying to provide more flexibility for folks that are feeling the tough times in 2020. But the thing to keep in mind on an individual level is that that loan, even while deferred, will still continue accruing interest. So again, it's a nice flexible feature, but if you can pay the loan back now, it might make sense to just go about doing so from day one. And then continuing on with that qualified individual theme, plan loans have been expanded under the CARES Act to the lesser of 100,000 or 100% of a participant's vested balance. And one thing to keep in mind from an HR or business owner perspective is that you may need to amend your loan program depending on the number of loans that are included currently. But the two questions that really come to mind right from the get-go when looking at this expanded loan is, does your employee really need $100,000 at this point? And are they going to be able to pay it back next year? And the reason I ask this is what we're seeing is truly unprecedented access to retirement plan assets due to this provision. So just for example's sake, if you have somebody coming to you for that full $100,000, the typical rate on a loan right now is prime plus 1, somewhere around 4.25%. So if they're looking to take that $100,000 and pay it back, you're looking at about a 5-year repayment program of $1,852 a month. And if you defer that another month here until the new year, that's going to go up to even closer to $2,000 a month. So it's a significant chunk of change. So you just want to make sure you keep that in mind when you're having conversations with employees, and also when thinking about rolling this out at a plan level, as if you have a loan provision in the plan already and it's not being used, then perhaps this isn't necessary in the first place. And the last thought I'll leave you with on that front too, when you have folks that take a loan throughout that run into tax consequences throughout the plan year and are looking for a way to pay that off in the spring, a lot of times we're seeing those folks coming to the plan to take a withdrawal or take a loan to pay that off. Those same folks are probably the ones that are going to be going into something like this and potentially defaulting on a loan. So it begs the question, if you get to that situation, where are those folks going to turn to pay off that unintended tax consequence at the end of the year? I'm jumping over a slide quick there. So continuing on with the CARES Act, 2 more touch points here. All required minimum distributions for 2020 have been pushed off. And this was something meant to provide flexibility so folks didn't have to liquidate in a down market. Obviously, like Brian touched on earlier, things are starting to turn around right now, so not quite as necessary as it might have been initially in the beginning of the year, but just another flexible provision. And then the last touch point, the $100,000 COVID-related distribution. So this is basically waiving the 10% early withdrawal penalty, and it gives participants 2 options. You can either take this all in the year of distribution, 2020, or spread it over a 3-year period, basically 2020, 2021, and 2022. That option has to be elected upfront. So if you elect the 1-year, if you elect the 3-year method, you're going to be paying it back ratably over those 3 years. If you elect the 1-year method, you don't have the option of paying it back in subsequent years. You would have to amend your current year tax return if you are to do that. And I think the key here again is just unprecedented access to retirement plan assets. So before you have any folks jumping to a knee-jerk reaction and saying, hey, my employees might need this, let's roll it out. It is a protected provision. So you want to sit down, have a conversation, see who's looking to take one of these, and make sure that it is appropriate for your business. And just to bring that all together, I know Tom touched on the restatement period. That just opened up July 1st, runs through July of 2022. The Secure Act and CARES Act, all those amendments need to be in place by the beginning of 2022 as well. So the idea here is that there is time. These all need to be addressed in the next year and a half or so. But I think the folks that get out in front of this and have those conversations, actively look at their plan, take a peek to see, is everything we're doing right now appropriate? Are there enhancements we can make? Are there things we can clean up around the edges? That's what we're here for. So please reach out to Tom and myself, Brian, Liz, with questions. And I'm going to turn things over from here to Liz to touch on her experiences with Sobel and Company and some of the common findings that she's seen in audits and things to be on the lookout for. Liz? Are you with us still, Liz?
Brian, it looks like we lost Liz. I'm not sure what happened.
All right. Well, while Liz is dialing back in, just to kind of add a little bit of an extra touch on this last slide here, with that restatement period, what we have been seeing as a third-party administrator is that a lot of bundled providers are trying to tackle that that process early in this restatement period, and just basically restating everything as it is. So I hate to use this phrase, but we're kind of calling it a garbage in, garbage out scenario where they don't really want to do much work. They're not consulting with their clients. They're just kind of pushing through everything as it had been in the past. So rather than kind of perpetuating that cycle, paying an ad hoc fee to restate your document with the IRS and not really deriving any benefit from it, our suggestion would be reaching out to us, having a conversation about it, sending over a plan document, sending over your census data to see how your employee demographics have changed over the years, and let our team take a look. We'll dig through it with our actuaries and our legal team and take a
I'm sorry, it's Liz. I'm calling
No
in.
problem.
I'm going to have Andrew remote me in, but I don't want to delay. I want to get started. I really appreciate. Good morning, everyone. It looks like I might be on, which is great. So I don't want to have both my phone and my computer on. Should I jump off the phone at this point?
You're coming through crystal clear, Liz.
Liz, we can't hear you now. No, Liz.
Okay, so you couldn't hear me. All right,
Now
because I'm talking on my phone.
Okay, now we can hear you.
I'll have Andrew remote back in. All right. So I wanted to jump back a little bit to some of the polling questions that we had, and I wanted to make sure that we covered those. Colleen, would you be able to, go to the polling questions, and then I thought I would start my session with one of my polling questions.
Okay, so we'll go to your polling question right now.
Yeah, that would be great.
Okay, there you go.
Awesome. Okay. Andrew, feel free to remote in if you want to try to get my
I think you're fine the way you are, Liz.
Okay, that's perfect. All righty. So we'll wait a few minutes. I did notice there was a second polling question, which I'm not sure if we addressed, but it looked like pretty much everyone on the call is involved with the 401k plan. And that seemed to be today's, participants, mostly they're all in 401k plans. So what I'd like to do is just get started with my first slide. My topic today is going to be covering common findings that auditors have. So what I will say is these are Liz's top findings, but these are also very common in the industry. So the first item that I'm going to note is the definition of compensation. What I will tell you is all too often, this is what we would find as a issue. And usually when we find that there's an issue with a plan not adhering to what their definition of compensation is, it could be systematic. So systemic throughout all of the participants. So I'll give you an example of one of our findings in the past. It's where a plan specifically says that it should not include bonuses or commissions. And then when we do our testing, we will uncover the fact that, in fact, bonuses and or commissions were included in the definition of compensation. And so the deferral amounts are not correct. So that's something you really have to take a lot of care in. What I will tell any plan sponsor that's on today's call, to make sure you have the plan document, right? If you're the one that's responsible for the plan, you should be very familiar with what it contains. And, a to-do item would be to definitely make sure you are fully understanding what the definition of your plan's compensation is, because it does vary from plan to plan. Let's see, moving on. The next item is minutes, lack of minutes. Let's see, during the conversations that Brian mentioned the importance of minutes. Brian Gregoff, and I will also highlight that as a common finding when we're doing our audit procedures. One of the questions that we would ask the plan, administrator is, do you have minutes? And they may say to us that, well, we do meet with the advisor, we met with them, and they'll give me something, what I will call a slide deck, which is great. That's a great start. But when if you were to ever be audited by the Department of Labor or the IRS, they would ask for these minutes to be more formalized, and to be in writing. So what I will tell you is I'm going to share with you a few tips that you could follow for minutes. One being that you might want to outsource those minutes. You might want to say to somebody that's part of your team, your pension team, to be the person that is going to, formalize those minutes with who attended, the date, the topics that were discussed, action items. What I would also tell you is that, you do want to keep it simple. You don't want to put in there information that could be construed questionably. You want to keep it simple. You want to note the action items and really just focus on opportunities for improvement. What I will just say, people ask me often, like, how many times should the plan meet? I will say that, at a minimum, once a year. I would advise, optimal number of times would be each quarter. So you have to determine what makes the most sense for your plan. So another common finding that we have relates to cybersecurity, and I know that was also mentioned earlier. And with cybersecurity, what happened was back in 2015, the chief accountant at the Department of Labor advised all plan auditors that they needed to speak to their clients about the importance of cybersecurity. And what I will also, I guess, highlight, if you are a client of Sobel's, that has been a topic that we would discuss with you and also share with you in a internal control comment to just give you some guidance. So cybersecurity could impact the plan especially when you're using outsourced providers. It could be payroll, it could be your record keeper. Just be really, really careful. And I think my top advice would be that you should always use a secure portal when transmitting information. And if you want to take it to the next level, at our firm as well, at Sobel, we have cybersecurity training. And we also, part of that training is they will send out phishing emails to see who needs more training. So, I would say that that aspect is important and will continue to be very, very important in the future as well. So, Colleen, can we get back to the polling question, the results of the polling question? And I think actually I can see it. So
yes, you can
here's
see
what
it.
I have. Okay, so I can see, let's see. I'm looking right now.
Under polls, do you see it?
Yeah, is your company, if your company sponsors a qualified plan, does it require an annual audit? So on the call right now, we have 13 participants, actually 14 participants, and they require an annual audit. So I'm assuming that, which is great. We have some that are either they don't need an audit or it's not applicable. Maybe they're thinking about instituting a plan. What I will tell you is these common findings don't only relate to someone that needs to have an audit. It really is fundamental. And if you were, selected for an audit by the Department of Labor or the IRS, they would be common questions and common areas that they would be focusing on. So that's great. Thank you. I think we can move on to the next slide. Excellent. Thank you. So auto enrollment and eligibility, I believe that was also mentioned earlier. And what I will tell you is I'm a firm believer that a plan is instituted. It's a great benefit for their employees. That's really short and sweet. That's why we have plans, right? So we can have our employees retire in the future, safer, save a nest egg. But auto enrollment and auto eligibility definitely enhance the magnitude of savings that a participant will have when they're in a plan. But it is a common area. It's where additional care should be taken when you're implementing those features specifically. So what we've seen is some audit findings where the auto enrollment and the auto eligibility is not being implemented in accordance with the plan document or the plan amendment. So just take extra care when you are implementing the new feature. And as it's December now, and as we enter the new year, again, refer to your plan document and see what does it mean, like what's going to happen with auto enrollment or auto escalation. Like, as we enter 2021, do we need to double check to make sure if somebody is being auto enrolled that they were properly enrolled. So I would just say take the care, take the time, and work with your TPA, your record keeper, to ensure that part of the plan is being implemented properly. So the next, I wouldn't say it's a finding, but what I would say is that it's a recommendation that benchmarking is something that a plan should have at least every 3 years. And Ryan, he mentioned earlier that, they run reports on a monthly basis. So each advisor, what I would say to you is if you have an investment advisor, that's a conversation that you should have with your investment advisor for you to better understand what benchmarking has taken place and what benchmarking should take place maybe in the future, and use those reports to come up with good action items. So what I will just, a high level introduction as to what the benchmarking may look like is it could take your current investments and put them into, quadrants. Hopefully most will be where, you've met or exceeded what your, the benchmark for that specific fund that you're in, that it's strong, it's vibrant, that, something to also look at would be the return in the returns in the fund, as well as, look at the expenses. I wouldn't tell you that, one factor is more important. I think it's a combination of both factors, meaning the rate, the returns of the funds, as well as you have to look at and consider the expenses associated with those specific investments. So the next area, hardship. Tom, you mentioned that auditors are going to have to probably perform more work, and you are correct that if the features relating to the CARES, the Secure Act are implemented, there could be additional work in that maybe if you allowed a participant to take a COVID distribution, that would be something that we would look at. However, my common finding now specifically relates to just hardship documentation. And what I will tell you is that if you're plan allows for hardship distributions, that you need to maintain that appropriate documentation. It could be that your plan allows for a hardship distribution due to medical bills, or whatever it is that it says in there. And if it were to allow, say, for medical bills, that you would need to, at this point, my belief and my understanding is that if the IRS came in, they would say to you, plan sponsor, please provide us with this documentation that you have on file. I know that with some of the COVID type distributions, there could be a participant could self-certify that the information that the information that they're providing is accurate. Excellent. So, Colleen, I have one question. Do we have any other polling questions that were not opened, or did we address all of the polling questions?
We addressed all 4 polling questions.
Excellent. Okay, great. And I'm ready to move on to the next slide. Okay, so another hot button and another area where we see multiple audit comments is on the timeliness of contributions. What I will tell you that if you are responsible for the plan, the rule, and I will give you the general rule, and this is the chief accountant at the Department of Labor says that each plan has to have their track record. They have to have and adhere to their own track record. So what I will tell you is if you can remit in 2 days, they could come in and we probably will highlight for you that you have outliers. What's the reason for these outliers? So if you remitted 10 times during the year, 10 days late, that could be an issue, and that you should really evaluate whether or not you should participate in any of the late filing programs, correction programs. So really make sure that you monitor. And my best advice is to have a spreadsheet where you take where the payroll date compares to the date that it was remitted to the trust, and that you really monitor that each time you have a pay period. The next item, they sort of, I would say, timeliness of contributions, and then the communication between payroll and record keeper relate. So what I will tell you is there are some payroll providers that can do an auto integration, a 360 feature that goes from your payroll and your record keeper, and that feature could be appropriate for your company. You also, could, what I will tell you is a common finding if you don't have that feature is where the payroll doesn't really communicate very well, where there are issues at times between the payroll provider and the record keeper. So just make sure that you do review reports, and that, that there's that reconciliation process. That's what I would tell you is probably something that all plans should have, is that reconciliation of the information coming from the payroll into the record keeper. So another common finding is forfeitures. And I know we're running low on time, so I'm gonna really try to go quickly through the topic. But what I will tell you is if your plan has forfeitures, which are the result of employer contributions that are not fully vested. So if you do have employer contributions, you have a match, and someone's not fully vested, let's just say they left and they were only 80% vested, the 20% would be rolled into a forfeitures account. And the forfeitures account is an account that should be continually evaluated and used. If it's not used, it could cause an issue, and the department could see the plan as a taxable entity. So my advice is to really monitor that account. And again, December is the best time to do this. You want your forfeiture account to be as low as possible as of 12/31. if it's not, and if you have an excess balance, and if it keeps growing, you will, or you should get a comment from your auditors. So Colleen, I'm ready to go to the next slide. Okay, I think you have to click one more. So I know this relates to, I'm sorry, for some reason the information on the documentation, basically what this slide is referring to is lack of signed documents and or no agreements with service providers. What I will tell you is that as a plan sponsor, you need to maintain appropriate files, which would include signed documents, which would, signed plan document, signed agreements with your providers. That is, if you were under audit again, and even if you're not a plan that needs Sobel to come in and do the audit, the IRS or the Department of Labor would ask you for these signed documents. And if they're not signed, executed, it could cause some issues. So that would be, I guess, my last item. So I guess I'm going to open it up for questions.
Okay, so actually, Colleen, if you could put all the panelists' contact information up. We have about 15 minutes for questions, so we've got time. But if we do, if you run out of time, you have the contact information up there to be able to reach out to one of the panelists with your questions. And again, as a reminder, put your questions into the comments box under the Q&A tab. You can also send me a private chat if you're more comfortable doing that. So one question we have is, what size plan sponsor, so in terms of number of employees, is most advantageous to participate in a PEP? I guess this one's more directed towards Brian B.
Yeah, great question. And I think that's a little bit of an open-ended question at this point still too. What we have seen traditionally is more of the smaller plans kind of banding together in that space. So more so, I would say companies with a dozen to a couple dozen employees than your big organizations where you're looking at 100+ employees. But having said that, at the same point in time, the common audit under the PEP, I think, is going to be one of those features that pulls in some of those companies that are getting closer to that 100 live threshold. So it's, I think a lot remains to be seen on that front. So I think the early days, we may see a lot of those small plans kind of banding together. Over time, though, I think you might start to see it kind of enter into the large plan space as well.
Okay, good. Anybody else from the panel want to add to that? Okay, next question. So this one, PPP loan related. So if a company is making contributions to their matching contributions to their plan, does that count towards compensation for the PPP loan?
If the contribution is made by the plan sponsor is a cost of the plan sponsor, then that would fall into the time period. It would depend also within that 8-week or 24-week, whichever one you chose, you had to make the contribution within your 8-week period.
Okay, very good. Anybody else on the panel want to add to that? Okay. All right, so next question, with COVID and with furloughs and layoffs, anything that the plan sponsors out there should be aware of for documentation or anything that you're seeing in the field that they should keep in mind? So for the entire panel.
Chris, I can take that. I can definitely start. It's a topic that we've even discussed with our own plans that we audit. So if your company is having a furlough, you really have to determine, are they going to come back, right? And if I would say that if you furloughed them, say in April, your plant was shut down, and you called them back in July or August, that shouldn't affect, like the number of participants in the plan, but there are special rules and, care that needs to be taken. So if you are on furlough, obviously you wouldn't be contributing. You have no, wages. So that's something to consider. So I would say from an administrative feature, HR departments are going to be very, very busy because they would have to, have brought back those individuals, and also payroll. So
Right.
yes, and documentation is key. Making sure that you fully documented like the pool of employees that were furloughed and then brought back, if that's the case.
Okay. And does any type of notice need to go to those furloughed employees, or, as you said, their compensation zero, so obviously there's no contributions, but is there any notice that needs to go to those employees?
So special notices are usually done annually. So in that case, yes, there could be, and I would think that it would be, if it was a significant furlough, like, yes, there should probably be a notice. I'm not aware of any of our clients that had furloughs and that, I guess I would question if anybody else knows, about the need to have a notice, but I would think you probably would have had to have had a notice, right? Because it's significant to the operations of the plant.
Yeah, I wasn't.
Has anyone in it? Yeah.
Yeah, I didn't hear anything about any notices, but I know with a furloughed employee, there definitely comes other challenges, meaning if you did have a furloughed employee who, say, had a 401k loan, right? Obviously, he's not receiving payments, or income to have that loan repaid. So what happens in those situations? To me, I understand there's two options. One, the loan goes into default, right? Which means he has to then either, make up the missed payments, or it becomes a deemed distribution, or under the CARES Act, and Brian, correct me if I'm wrong, he could actually select the delay of or suspension of payments until January 1st, and then therefore the missed, that loan missed payments along with any interest that has accrued would then be reamortized effective January 1st, and they'd be able to have that pay. So I know there's a lot of challenges that come with furloughed employees. It's not, in addition to, just the situation of them not being there anymore, receiving income, how they are participating in the 401k plan. I don't know, Brian or Tom, if you had anything to add on that.
Yeah, I would just say those are the kind of situations that we want to get under the hood and take a look at the census data and see how things are changing with you. And every company is going to be unique, but especially in 2020, when you're kind of furloughing folks, typically those are a lot of the lower paid staff at times. So from a testing perspective, it can have a dramatic impact. So we want to get out in front of those dialogues. That's something we're having conversations on mid-year with clients, so that it's not a surprise when year-end testing rolls around. So please engage us on that front where you have questions.
Mm-hmm.
Good point.
Great. Any additional add-on comments to that? Otherwise, we'll go to the next question. Okay, so this one, a couple of questions coming in on matching. So, kind of related to that. So, as companies analyze their budgets as they're getting closer to the end of the year and evaluating income and expenses, they might have a matching program in place, and they might have suspended it during the year, or they're considering suspending it. What are some of the things they need to be aware of in terms of maybe plan amendment or documentation along those lines?
I can start that question. So as an auditor, I think what I would usually, if somebody's suspending the contribution, it would be in the minutes. It would, it could be in the plan minutes or in the company's minutes, the actual sponsoring entity. So that would be number one. Number two, I would say that, that could take place anytime. So I'm going to just do a hypothetical. If it took place in 2020, as the auditor, we would specifically select maybe when it was, implemented and test to make sure that, yes, in fact, the match did not take place. What I will tell you is, since, again, we're in December, happy holidays, everyone. now's where you will be maybe setting up what your plan is for 1/1/21, and maybe you're looking and you're saying, you know what, we're just gonna tighten the ship. We're gonna cut down, like somebody, I think you said in the question, cut some expenses. So you would make sure that that plan agreement, or I'm sorry, the plan amendment is in place, so that you can, properly implement the feature, right, as of 1/1/21. You want to make sure that it's properly implemented. So there's a lot of things that have to take place. You have to talk to, make sure your payroll provider has this information. And really, that's probably the number one, is that the payroll provider understands that you are no longer going to be doing the match. And then therefore, you wouldn't need to remit that through payroll. So.
I would add on, I agree with everything Liz said. I would add on a planning aspect to a match. We need to separate in our minds that the company has a match or has an option to do a match, and the timing of the payments from the sponsor into the plan. I know it's very, easy, quote unquote, for any payroll provider to say, here's the compensation, here's what they deferred, therefore the match is this, and automatically pull it out of and make it part of the biweekly or semi-monthly payroll. That's not a requirement under the law. We have many, many clients who have a match, but they fund it at the end of the year. There are problems, and I don't know if Liz wants to talk about them, but that pay-as-you-go match can become a problem if you have somebody who is asymmetrically contributing into the plan. They're contributing a lot in the first 6 months and not a lot in the next 6 months. It can be a problem, and it can lead to an audit issue. So separate in your mind the concept of the match with absolutely tying it to a biweekly payroll.
And
yes, I do agree.
Go ahead, Liz.
And as you said that, I do know that some of the plans we audit just do the match. Some do it quarterly, and others just do it annually. So I would say that if you are one of those plan sponsors and you do it annually, and maybe, December 2020, you decided that you're not going to have a match, you need to make sure you've covered yourself and that you have all the appropriate amendments in place and documentation to support that decision.
Great. And I guess the follow-on question to that, in terms of, documentation for the plan, but what about notice to employees for changing the matching policy? Is there a notice?
So you're asking about changing the percentage mid-year, or
Changing the percentage mid-year? It could go from whatever it is to something less, or even to zero. What's the notice requirement to employees?
Gotcha. So typically with the discretionary match, it's not as stringent as you would see with a safe harbor requirement as far as notices go. What I would say is best practice, if you are making an adjustment to the match going forward, you do want to notify employees just so there's no surprises. So more of just a best practice more than a explicit requirement, if you will.
Right. So Chris, what I've seen in the past is just a letter from the company, a one-page letter that just says that, the company decided to suspend the match for 2020, for the year 2020, and at a later date they will reevaluate it, and it's as simple as that. That's what I've seen. So communication is really important. I mean, at the end of the day, it's our employees, and I always say the reason why we have these plans is for our employees. So it's a great benefit, and that's really what you just want them to know, that put a lot of thought into it, and it's the best decision for the company at this time.
Right. So in terms of, that's why most employers implement these plans is to provide benefits and attract and retain employees, but there's no definitive DOL requirement. So it's just more from a employee relation standpoint, best practice.
It's definitely a best practice. I'm not aware of a notice that would need to be sent out.
Mhm.
Okay, great. All right, so we're actually 1 minute over at this point. So I'd like to thank all the panelists and thank everybody for attending. And if you have any additional questions, please take a screenshot of the contact information. And also, before you leave, go into the handouts tab if you haven't done so already to pull down a copy of the presentation. And be on the lookout for that survey. You need to complete that in order to get the CPE credit, and the certificate should be mailed to you in a few days. Thanks, everybody.
Chris,
and,
on behalf of Sobel, I'd like to thank you for moderating today's panel. Brian B., Brian G., Thomas, thank you so much for your time and your efforts, and for making the presentation a success. Thank you.
Thank you, Liz.
Thank you
And
Appreciate
for
it.
happy
having us,
holidays,
Liz.
everyone.
Thank you, everybody. Have a great
Have a great day, everybody.
happy holidays.